The first lie about money is that it belongs to you. The second lie is that you are free to choose how to use it when your life is already wired to extract value from you in exchange for survival. This is not financial advice. This is financial education, the kind that makes your stomach drop because it forces you to look at what is happening beneath the slogans. In 2026, you are being squeezed from three directions at once. AI is cutting the middle class ladder faster than anyone predicted. Housing has permanently separated from wages, and even when inflation looks calmer on paper, your purchasing power still hasn't returned. Meanwhile, the rich keep getting richer in the background of your everyday panic, and the system never feels like it is meant to help you. It feels like it is meant to manage you. So here is what you will learn today, in cold language. There are 5 rules behind money and wealth, not 5 rules from a guru who sells courses. 5 rules that explain why some people build assets while most people build liabilities, why people with average income end up working until they die, and why the rules of good behavior are often just a trap that keeps you compliant. And along the way, I am going to show you the mechanisms, how credit works like a cage, how the job market is being repriced by AI, how interest rates hit ordinary households through the back door, and why the richest people treat cash flow like oxygen. If you think you are doing fine, great. Keep watching. Because the part nobody wants to say out loud is that fine is not a state of safety. Fine is the delay before the next bill, the next layoff, the next rent increase, the next insurance shock, the next health expense that quietly detonates your plans. Let's start at the beginning, because the rules of money always start long before you realize you are learning anything. When you were a kid, money probably looked simple. You got it as pocket change, as birthday money, as money from parents who said yes. Maybe you remember the moment you asked for something and your parent gave in. Maybe it was a game console, maybe it was clothes, maybe it was a phone upgrade you didn't earn. And did they ever sit you down and explain the actual math? Probably not. They told you to be a good person, to work hard, to study. They told you not to buy junk. They told you that money is responsible and that greed is bad. Then you got older and money started to come with strings. First it was school, then it was the job application, then it was start at the bottom, then it was the lease, then it was the credit card, then it was the mortgage payment that looks stable only until it isn't. And every step of the way you were trained to confuse two different things, cash and security. Here is a micro story I want you to feel, not just hear. Picture a 32-year-old nurse named David. David did not grow up rich. He grew up with the kind of optimism that gets punished. He worked rotating shifts, picked up overtime, and told himself it was temporary. He paid off a chunk of debt. He saved. He did everything you are supposed to do. Then, in 2026, his hospital started using more AI-driven scheduling and fewer middle shifts. His overtime got cut, not removed entirely, just trimmed enough to make his monthly budget wobble. Meanwhile, the rent he signed for 2 years ago is now up again because the neighborhood got repositioned. David checks his balance and realizes his salary buys less than it did in 2019, even though inflation has been described as cooling. That is your first clue. Money rules are not about your effort, they are about your position inside a system that controls supply and demand for labor, for housing, for insurance, and for credit. Now let's talk about the first rule of money. The one that people skip because it sounds too abstract. Rule 1 is understanding the relationship between society, information, and wealth. In hunter-gatherer times, the foundation of wealth was land and access. If you could hunt, if you could move, if you controlled territory, you controlled survival. Then agriculture came and land still dominated, but it concentrated wealth even more. Later, industrial society tied wealth to machines, energy sources, and production capacity. Oil mattered, coal mattered, factories mattered. If you knew how to run a pipeline, how to run a plant, how to run a supply chain, you mattered. But in the last 20 years, something changed. Knowledge stopped being a side advantage and became the main engine. In 2026, the wealthiest companies do not own land the way the old empires did. They own leverage over information, software, patents, data pipelines, distribution channels, cloud infrastructure, ad systems, and proprietary models. That is why the biggest billionaires you see are not always factory owners in the traditional sense. You see people building ecosystems around information and computation. Elon Musk, Bill Gates, Mark Zuckerberg, Larry Page, Sergey Brin. You can argue about their personalities all you want, but the mechanism is visible. They are tied to the economy that runs on intelligence and networks, not only on physical output. And here is where your emotional training gets exploited. You were taught to believe wealth is about hard work and persistence. That is partly true. Hard work matters. But hard work alone does not determine where the money goes. The real question is, do you own the lever or do you rent the lever? Let me give you a story that makes the point without needing philosophy. There was a case people use as an illustration. A Japanese printing plant's machine breaks. Workers spend days trying to fix it because they are stuck inside the problem with no key. Finally, the owner calls an American engineer. The engineer looks at the machine for a short time, draws a line with chalk on the outer shell, and says, "Open it here and check." The workers do it, the issue is found quickly, and the machine runs again. The owner is annoyed by the price. "You drew a chalk line," he thinks. The engineer replies that the chalk line was cheap. The value was knowing where to draw it. That one mark is connected to context, to training, to pattern recognition, to the mental model of the system. In a world where information is the lever, the richest people are the ones who understand where the chalk line should go and how to monetize the outcome. That's why in 2026, AI is not just a gadget, it is a redistribution machine. It takes tasks that used to belong to mid-level workers and turns them into automated steps. It doesn't eliminate every job instantly. It eliminates the jobs that are easiest to codify. It eliminates the middle first, the routine coding, the transcription, the analysis that used to be done by teams. Then it eliminates the expensive humans who were doing it manually at scale. So when you hear advice like, learn to code, I want you to understand why it sounds insane now. AI does basic coding faster than most humans can. AI does debugging patterns like it has been doing them since birth. Your competitive edge is not syntax. Your competitive edge is strategy and ownership of distribution. You cannot outlearn a tool that learns faster than you can breathe. But that is not even the worst part, because even if you accept Rule 1, you can still lose. Which brings us to Rule 2, the one that sounds moral until you realize it is economic. Rule 2 is separating money from emotional needs. In normal life, money and relationships collide so often that people stop noticing the damage. But if you want to understand wealth, you have to stop treating money like a feelings problem. Money is a decision tool. Emotional decisions destroy portfolios and friendships. People will tell you, if you love me, you will understand. If you care, you will help. If we are family, you can borrow. And maybe they are sincere. But sincerity does not pay interest. Here is the philosophical question that matters. If the most important person in your life asked to borrow money, would you lend it? If you say yes, ask yourself why. Is it because you trust them to repay? Or is it because you fear the emotional consequences of saying no? In the old money lessons, the uncomfortable truth is that there are trades you should not mix. You separate romance from finance, you separate friendship from credit, you separate family bonds from loan terms, not because you are cold, because you are rational. This is why people sometimes get happier after signing a clear agreement. In some marriages, couples establish rules about property and debt so that love is not forced to negotiate with money anxiety later. When you remove ambiguity, you remove resentment, you remove the invisible power struggle. You stop the silent question of, are you using me? Now take it out of romantic life and into the real world of your paycheck. Friends borrow for emergencies. They borrow to cover a bad month. They borrow because they will fix it soon. And you tell yourself that the worst case scenario is unlikely. But lending without contract is not generosity. It is gambling with your savings. This is how it usually ends. At first you feel important. You feel like a protector. Then the repayment becomes delayed. Then you start getting vague excuses. Then you start avoiding each other. Then the friendship turns into a debt relationship. Then the debt relationship turns into hostility. You wanted a friend. You accidentally bought a permanent conflict. And yes, there is a reason big institutions dominate credit markets. Lending is not just an emotional act, it is business. It is structured exchange with terms, interest, time, collateral, and risk. Banks exist because someone has to do the boring work of pricing risk. So here is the rule in a sentence. If you lend money, you are not lending to help a person. You are lending to finance a cash flow gap, and you must price it like a transaction. Let's zoom into 2026. Interest rates are still a live weapon, even when people say the Fed is done tightening. The Fed influences borrowing costs across the economy through policy expectations, treasury yields, and the interest rate channel. When rates rise, credit becomes more expensive for everyone, but the impact is not evenly distributed. Renters feel it through landlords who chase returns. Homebuyers feel it through mortgage resets and affordability constraints. Small businesses feel it through higher financing costs, and households feel it through credit cards that keep getting repriced. But the emotional trap is that you are still being asked to treat money like feelings. You are asked to lend to friends at low or zero interest. You are asked to help family without contracts. You are asked to absorb the risk because the relationship matters more than the numbers. So you end up with two problems at once. You lose money and you lose the relationship. That is not a failure of your heart. It is a failure of your system design, which leads to Rule 3, and this one is the most ruthless. Rule 3 is the importance of cash flow. People say rich people have money. That sounds normal. It is also wrong. Rich people have cash flow that survives shocks. A company can carry debt and still live. If it has consistent cash inflows, it can refinance. It can cover payroll. It can wait out volatility. But a company that runs out of cash, even if it looks solvent on paper, will die, because obligations do not care about your optimism. The same rule applies to households. Your bank balance is not a trophy. Your cash flow is your oxygen. Let me tell you a story that is basically about money moving like blood, not money sitting like dust. In a small town, every household owes every other household. Each person is stuck with a ledger that never gets resolved, because nobody has liquidity at the same time. Then a traveler arrives and wants a room. The innkeeper asks for a deposit. The traveler pays. The innkeeper immediately uses the deposit to pay his own debt to a butcher. The butcher uses it to pay a tailor. The tailor uses it to pay a grain seller. The grain seller uses it to pay the innkeeper's outstanding rent balance that had been stuck. Finally, the traveler decides he does not like the room and asks for his deposit back. The question is, did the money disappear? No. The money didn't get lost, it circulated. It cleared obligations that were previously tangled. Liquidity moved through the system and made the network function. Now think about you. If your cash stays trapped in savings goals or in a retirement account that you are not touching, it is not bad. It is just not doing the job. Cash flow is designed to do. Meanwhile, the moment you need liquidity, your credit card limit becomes your emergency supply chain. That is why millions of people in the United States, the United Kingdom, Canada, Australia, and across Europe are trapped in a revolving door of minimum payments. In 2026, that trap is tighter because wages have not fully recovered their purchasing power. Even after inflation cools in official numbers, real life is still expensive. Groceries, energy, childcare, insurance, and travel. Insurance markets are collapsing in certain regions because climate-driven events are making payouts more frequent and more costly. Then premiums explode. Then people cut elsewhere. Then debt grows. So when you learn Rule 3, you stop believing in someday. Cash flow decides your tomorrow, but we are not done. Rule 3 is bad enough. Rule 4 is worse, because it attacks the lie that money's value is what the number says. Rule 4 is that money's value is not determined by its face value. It is determined by purchasing power, context, and trust. You have probably heard of hyperinflation. It sounds like an extreme historical event from another planet, but the mechanics are not as distant as people think. In a hyperinflation environment, the currency number keeps growing while the real value collapses. The Zimbabwe example people mention is famous. Huge denominations printed, but bread costs so much that people carry bags of cash to buy basic food. That is the extreme case. But the principle is universal. A number on a bill is not value. Value is what you can get with it, reliably, within a time window that matches your obligations. Now let's bring this into 2026 normal life. Your paycheck is a promise. Your rent is a demand. Your mortgage is an obligation. Your healthcare is a recurring threat. If your income growth is slower than inflation of essential expenses, your money shrinks in practical terms. That is why real purchasing power matters more than headline inflation. The Fed might say inflation is near a target level. That can still mean your groceries are up, your insurance is up, your housing costs are up, and your wage did not catch up. So you feel poor even when official metrics improve. Now add the wealth concentration layer. In 2026, the top 1% continues to own more than ever in real terms. That is not just a moral issue, it is a mechanism issue. Wealthy households have assets that compound. They have access to better credit terms. They can borrow against assets at low rates. They can time markets and avoid forced selling. While you are told to save and behave, the rich are often borrowing while they appear wealthy on paper. They use financial engineering, they use tax planning, they use legal structures. They do not need to chase a paycheck every week because their wealth is already producing cash flow. So Rule 4 is basically this: do not worship denominations, worship the system that produces purchasing power for you and punishes it for others. And here is the cliffhanger that matters. When you understand Rule 4, you realize something ugly about careers and education advice. People say, get a degree, work hard, stay employed, it will pay off. That is a story designed to comfort you, but in a world driven by information and AI disruption, the market is repricing labor continuously. Some of the repricing happened in tech, yes. But it also happens in finance operations, customer support, legal drafting, logistics planning, marketing content production, and even parts of creative work. AI can write drafts. It can categorize. It can summarize. It can generate customer responses. It can assist analysts. That means the baseline for entry-level tasks drops, which means the bargaining power of typical workers drops. Now think about how your salary is set when you are young. It is usually based on surveys and average expectations. The market thinks your worth is your marginal productivity at the job level, not your long-term value to your own future. You get hired, and the system trains you to stay within a lane. It is easier for companies if you never become a strategist. It is safer for them if you remain replaceable.
A lot of people unknowingly accept a role identity like a customer accepts a defective product. I am a blank slate. I am a junior. I am here to learn. And then they act like a commodity. They look for the nearest paycheck. They do not treat employment as an asset-building strategy. They treat it as a survival tax.
The cruel part is that this identity becomes self-fulfilling. You attract low-cost opportunities because you present yourself as low-cost. You get trained to accept normal pay because you are not negotiating for a higher leverage position. So to obey Rule 4, you have to treat your value like a product with pricing power, not by chasing prestige, by creating differentiators that AI cannot simply replicate at scale. Which brings us to Rule 5, the